Corporate procurement fraud rarely looks like a heist. In most cases, the perpetrator doesn't break the rules or bypass the system. Instead, they weaponize the organization's daily routine, using the standard workflow itself as the extraction mechanism. Look at a typical payment file. You see a matching purchase order. You see a properly formatted invoice with the correct tax identifiers. You see an authorized manager's digital signature releasing the funds. The file looks flawless on screen. But step away from the digital trail and look for the actual goods or services provided, and you find absolutely nothing. Procedural completeness does not equal commercial reality. This gap exists because organizations routinely make a dangerous assumption. They treat the completion of an administrative process as undeniable proof of economic truth. Fraud actors study this behavior. They know that if they can supply the required paperwork and check the right boxes, the organization's own dedication to compliance will act as a shield, protecting the fraudulent payment from scrutiny. To engineer a successful procure-to-pay exploit, an attacker needs exactly two components. They need a destination to receive the funds and a trigger to initiate the movement of that cash. The destination is known as a ghost vendor. This is a compromised supplier identity living inside the vendor master file. It represents a total failure of upstream master data control. The trigger is the phantom invoice. This is a request for payment lacking any legitimate economic basis, inserted downstream to activate the cash release. Neither component is designed to stand out. Attackers use familiar cost categories like consulting or maintenance. They keep the dollar amounts moderate, intentionally pricing them just below internal threshold alarms. Because the destination and the trigger blend perfectly into the daily rhythm of the accounts payable department, they easily bypass initial administrative checks. The entire burden of catching the theft is shifted onto the organization's complex approval workflows. Think of the vendor master file as the root system of your financial environment. It's the gatekeeper determining who is eligible to receive company funds. If a toxic entity breaches these routes, it compromises the trunk, contaminating every invoice branching off it. A common misconception is that a ghost vendor is simply a fictitious company invented out of thin air. While that happens, the reality is often much more subtle. A ghost vendor is often a formerly legitimate, dormant supplier reactivated by an insider. Or it could be a highly active, real supplier whose bank routing numbers have been intercepted and altered. Or it could be a registered shell company secretly owned by an employee. The standard transactional error results in a single, isolated loss. A compromised master file creates a durable, fully authorized channel for repeated theft. Once the fraud actor secures a place inside that master file, their hardest job is done. Every subsequent downstream invoice requires almost zero effort to process because the financial system already treats the payee as a verified, trusted partner. With the destination secured, the attacker deploys the phantom invoice. This is the mechanical trigger used to pull cash through the compromised gate. If you examine these fraudulent invoices, you will notice a strict preference for billing services rather than physical goods.
Tangible goods create a paper trail that is difficult to fake. Receiving a large shipment of laptops requires detailed warehouse entry logs, physical inventory counts, and loading dock sign-offs. That physical barrier stops most phantom billing schemes. Intangible services, however, leave almost no physical footprint. Categories like IT support, advisory fees, or marketing consulting lack immediate hard evidence of delivery. Validating them relies almost entirely on subjective managerial approval. Fraudsters exploit this by submitting invoices with deliberately vague line items, like Phase 1 logistics coordination, and they ensure the total price sits right below the threshold that would require a second director's signature. Relying on one manager's subjective feeling to validate an invisible service creates the perfect environment for a massive systemic failure. We call this the assumption cascade. This diagram maps a standard procure-to-pay workflow. The department head approves the budget. Finance verifies coding. Procurement confirms the purchase order. Midway through, the transaction has secured 3 official stamps, yet absolutely no one has checked if the service took place. Next, accounts payable performs a 3-way match, blindly assuming everyone above conducted a substantive review. Finally, treasury authorizes the wire.
This delegated reliance trap proves that rigorous controls actively carry phantom invoices to the finish line. You cannot fix this vulnerability by simply adding a sixth signature to the approval chain or making the workflow longer. That just adds another layer of blind trust. Defeating procurement fraud requires a shift in how the organization thinks about documentation. Teams must stop checking boxes and start verifying commercial substance. The primary defense mechanism is the strict segregation of validation points. Different teams must independently verify different aspects of the transaction without relying on downstream or upstream assumptions. Specifically, you must isolate 3 independent checks. Vendor identity must be independently validated at the master file level. The physical substance of the delivery must be proven with hard evidence. And any changes to routing data require independent bank account confirmation directly with the supplier. Breaking the reliance cascade requires instilling deep professional skepticism at every single level. Staff must feel empowered to halt the workflow and withhold their approval until independent evidence proves the transaction is real. A perfectly complete file of digital documents proves someone knows how to use your ERP system. It does not prove service delivery, vendor independence, or an absence of internal collusion. Ghost vendors and phantom invoices thrive in environments where administrative routine entirely replaces critical scrutiny. But the exploit instantly fails the moment a professional steps out of the workflow, looks past the PDF, and connects cash to physical reality. Finance and audit professionals must actively interrogate perfect paper trails. You have to ask what the documents actually prove, and more importantly, what they leave unproven. True internal control is not achieved through a flawless, uninterrupted chain of signatures. It is achieved through the relentless verification of reality.